Deferred Tax Assets and Liabilities, Tax Video 1D. This is Ken Boyd, the owner of St. Louis Test Preparation. Here's our Facebook page and my email, and also the website. And finally, the book, Cost Accounting for Dummies, that is now available on Amazon.com. This video is taken from a blog post that I did within the last month or so on deferred taxes. So I wanted to go over this. This is a tough concept. I spent a tremendous amount of time on this concept. It's one of the most important ones that I work with people. So it's called Pay Me Now, Pay Me Later Deferred Taxes. And there's a challenge when you're posting your accounting transactions from your books to filing a tax return, because you've got two sets of rules. You've got book or your accounting records, and tax, which is your actual tax return. And with taxes, there are really two types of differences between book and tax income. A permanent difference in blue says there are transactions in your accounting records that never appear on the tax return. And the reverse is also true. There may be items that do appear on the tax return that never appear in your accounting records. That's the reverse right here. So there's a difference in tax liability because there's a difference in income. So the income tax liability you post to your books, if you have a permanent difference, will never agree with the liability that you have on the tax return, and we call these permanent differences. More common is a temporary difference, because a temporary difference is a matter of timing. Now, just like the permanent difference, the tax liability you post to your books on your accounting records is different from the amount on the tax return, but the difference is temporary. And the thing to remember with temporary returns is, eventually, your books and your tax return will agree in total. That's the thing to remember with temporary differences. So, in some years, maybe the early years, the amounts may be different, but by year 5, the tax liability for all 5 years, the book tax liability equals the liability in your tax return once you get enough years out into the future. Another thing that's confusing is the word deferred means different things depending on what you're talking about. Now, defer commonly means to put off something. If we have a temporary difference, again, where things eventually even out, you may owe more taxes later because your income will be higher later. And I'll say that again. You owe more taxes later because your future income is higher later. We call that a deferred tax liability. It's deferred because you're putting it off. It's a tax liability because you owe more taxes. If you owe less taxes later because you'll have lower income in future years, we call that a deferred tax asset. It's an asset because you owe less tax. It's deferred because it happens in the future. And I say again here, this zero-sum game about temporary differences is actually a good phrase to excuse me, remember. Over the long term, the tax liability that's on your books and on your tax return will agree in total. If you look at it in terms of a T account, eventually a deferred tax liability, which I'll explain more on later, will be completely offset by a deferred tax asset. So typically in a T account, you'll see deferred tax liability on one side for deferred taxes, deferred tax asset on the other side of the T account. And what we're saying with the temporary difference is eventually the deferred tax asset and the deferred tax liability will cancel themselves out. I'm going to skip down to the continuation of the conversation here. And what I walk through is a temporary difference using depreciation. Depreciation is a great example to use for temporary differences. It's the most common one. A practical reason why it's used as an example is that the depreciation schedules are often different between the books, the accounting records, and the tax return. But total depreciation, going on with our theme that we've seen, is the same using both methods. So let's assume you own a truck, excuse me, that costs you $20,000. So the maximum you can depreciate the truck is $20,000. After $20,000, the asset has no more value. Now, in this example, the rate of depreciation, how fast you depreciate that asset in terms of a percentage, differs between the book method for accounting and the tax method. So here's my $30,000 truck. I'm going to call that $30,000 rather than 20. Let's say for book purposes, we depreciate the truck $10,000 a year for 3 years, and we're fully depreciated on our books or our accounting records. For tax depreciation, we depreciate more in year 1. We depreciate $20,000 versus 10, and the last 2 years we depreciate $5,000 each. In total, both methods of depreciation total $30,000. Okay? And I should fix this to 30,000 as well so we're consistent. So what about year 1? Okay? We have more tax depreciation in year 1. So your tax return shows $10,000 more expense. The flip side of that is on your tax return, you will owe $10,000 more later. Less now because you have more expense, more income later. So that's a deferred tax liability later in the amount of $10,000, which was the difference between the $20,000 tax depreciation and the $10,000 book depreciation. Okay, if that's the difference in income, how much do I actually owe? Well, if I assume my tax rate's 30%, I would owe the $10,000 difference times 30% for $3,000, and that is a deferred tax liability. To finish up the example, let's talk about year 2. Well, in year 2, tax depreciation is less than the depreciation on the books. We're only depreciating $5,000 for taxes versus $10,000 on the books. So we have more taxable income now and a higher tax bill. And if I multiply that $5,000 difference by 30%, 5,000 times 30 means that my taxes are going to be $1,500 higher in year 2 because I have less depreciation for taxes, more taxable income multiplied by 30%. So we have a deferred tax asset. I pay more taxes now and less taxes in another period. That's an asset. If I'm paying less taxes in a future period, that's an asset. So year 3 is just like year 2, same calculation. We come up with a deferred tax asset of $1,500. And if you add up our 3 differences, which goes on to the bottom page here, you'll see that we had a deferred tax liability in year 1 of $3,000. Years 2 and 3 give us a deferred tax asset of $1,500. So if I add the liability and the assets, since they offset, the total assets and liability net out to 0. And another thing that means is that the 2 methods, book and tax, both give us a $30,000 depreciation over the 3-year life of the asset. So in total, book depreciation and tax depreciation were both $30,000. They were just recognized unevenly. That's as far as we're going to get on the deferred tax assets and liability. You can go to Amazon.com for more on the book. For one-on-one tutoring sessions, you can go to the website. You'll see the blog, and here's our Facebook page. Thanks very much for watching, and we'll see you next time.